So today we're going to talk about some of the different options that contractors have when it comes to financing their business. Some of the most popular ones, including lines of credit, business credit cards, factoring, project-based financing, which includes material financing, and then supplier terms. Uh, Cash flow strain is a pervasive problem in construction, and it's because of the construction payment cycles and how those typically work. Contractors are forced to purchase materials, pay for labor, typically before they're paid for the job. That makes it extremely challenging. You end up getting a backlog of invoices that start to pile up. You haven't been paid for your job. It really hinders your ability to grow your business, invest in new resources, invest in crew, and take on really larger or more projects at the same time. And so what I'm going to talk about today are some of the different options for financing your business to help you grow. So the first one that we'll talk about is a line of credit or a bank loan, usually issued by a bank or a credit union. These are available capital that can really be tapped at any time, but contractors should be careful. They should really only be used in kind of emergency situations, really as a lifeline, not necessarily as your go-to source of working capital. Really with credit limits, the challenge is if you miss a payment or if you go too high on your credit utilization, meaning let's say you have a $50,000 line of credit and you've used $45,000, which puts you at a 90% credit utilization, other sources of financing for you may get cut in half. You may have a credit card that's $50,000 in available credit that gets cut to 25, or you may, with that exact bank loan, you may actually get that cut in half as well. So the different sources of financing for you are monitoring closely how much you're pulling on those different sources of lines of credit. So be very, very careful. The other thing that's risky with lines of credit, a bank will likely take a blanket lien on your business, making it difficult to go obtain additional financing if you need it. So really, you should have a line of credit, again, for emergency expenses when you need them, but you shouldn't rely solely on it. The last thing related to lines of credit and bank loans, you're going to be dealing directly with a banker. You're not going to be dealing with someone who fully understands the construction industry. And so you want to keep that in mind. They're not going to understand construction payment cycles. They're going to really be approaching it from a banker's mentality. The next one that we'll talk about is a business credit card. I'm sure most of you have one. Most companies should. They usually come with a predetermined credit limit similar to a line of credit. But business credit cards are usually unsecured, whereas lines of credit are typically secured. Business credit cards will likely come with less of a credit limit than a line of credit. You should really be using those for kind of smaller expenses. You shouldn't be putting, really large material purchases or equipment necessarily on a business credit card. Those are more, those should really be financed with other ways, either through cash, either through terms, either through, material financing or something of that sort. So business credit cards, while they're great, should really be used on smaller expenses. The next one is invoice factoring. Invoice factoring is when a factoring company will actually purchase your invoices and take over the receivable from you. So one of the challenges here is that you actually have to have enough capital to do the work, to pay for the materials, to pay for the labor, to actually get to a point where you can submit an invoice. Once the invoice is submitted, it may still take 30 plus days to get paid from your GC through the pay app. And in that instance, you may need that cash to go buy materials for a new project, for the same project. And in that instance, you may need that cash quicker. And so a factoring company could be a decent solution. There is a negative stigma. It really should be a last resort if you absolutely need the cash. Factoring is fairly pricey, and it does kind of signal to your customer, to your GC, that you really you're having trouble paying your invoices. So be careful with it, but at the end of the day, it could be a solution if you need cash. Next, we're going to talk about project-based financing, really specifically material financing. And one of the benefits to that is you're working directly with a construction expert, really a consultant in the construction industry who is an expert in finance and managing cash flow. And you're working with them. They understand your business. They understand the project that you're on. They understand construction payment cycles. Whereas when you work with a bank, you're working with someone who has maybe broad finance knowledge, but doesn't necessarily understand the construction industry. Second, what's great about project-based financing and material financing is it's very quick, fast, and easy. And this goes back to working with a construction expert. They know that you need materials now, so they can fund really same day if you need it. And the way it works is they'll pay your supplier up front and then extend you up to 120-day terms, or a pay when paid solution. So we're really flipping the construction payment cycles on its head, allowing you to actually get paid before you actually pay for materials and labor. So that's the way project-based financing works. And a lot of the limits and the credit limits from project-based financing are based on the project that you're working and the quality of that project, as opposed to your personal credit score or FICO score. So there's a lot of benefits to project-based financing. The last thing I want to talk about today is supplier terms. Many of you will have terms with your supplier. You will, usually when you start with a new supplier, you'll fill out a credit application, and they will extend you either 30 days or potentially 60-day terms, which means that they'll ship the materials and ship the goods to the job site, and then wait 30 or 60 days before the invoice goes out, and you'll owe money at that point. The problem with supplier terms is many times you're not actually paid for 90 to 120 days. So you're still floating that cost for at least 30 to 45 days, even with supplier terms. The other challenge with supplier terms is that most suppliers, when you have open credit with them and they've already extended 30-day terms to you and you haven't paid them back, if you need more materials for that project, or maybe you are awarded a new project, you can't really go back to them and get more credit. They're usually going to cut you off until you pay back your cost for the original materials. And so with something like project-based financing, if both projects are solid, you may be able to open up multiple job accounts, with the same supplier, which is really a game changer. So while supplier terms are great, there are limitations, and that really you need to be aware of.